Greetings to Dr. Mahama and everyone. My name is Brandon Leong.
I'm Lau Yue Hin.
And my name is Hoi Ching Jien.
Today, our group is going to present our financial reporting group assignment. So first off, I'll pass to Lau Yue Hin to present his part.
So firstly, Bonia is an international luxury fashion retailer based in Malaysia. Bonia is principally engaged in product design, manufacture, promotion, marketing, distribution, wholesale and retail of luxury leatherware, footwear, apparel, accessories, and eyewear for both men and women under its in-house brands as well as other international licensed brands. In addition, the group offers management services and invests in real estate. Products are offered through a large number of independent boutiques and consignment counters in Malaysia and Singapore. Their goods are distributed to other foreign markets via retail outlets run by their distributors, dealers, and licensees. So next, Zara is a Spanish multinational retail clothing chain and also one of the largest international fashion company. Inditex, one of the world's largest distribution groups, where Zara belongs to. Zara is specialized in fast fashion and sells clothing, accessories, shoes, beauty products, and perfumes. Zara stores have men's and women's clothing as well as children's clothing. Zara Home Designs are located in Europe stores. Under its Zara Home line, Zara launches what is believed to be the first detergent that reduces the abrasion of textile microfibers during washing. It is claimed the solution, jointly developed by Inditex and BASF Home Care and I&I Solutions Europe in Spain and Germany, can reduce the release of microfibers by up to 80%, depending on the fabric type and washing conditions. So next, I'll pass to Brandon to talk about the ratio analysis between these two companies.
So for the 5-year trend analysis, our group have chosen Zara as the competitor of Bonia. The 5 ratios that we have chosen are net profit margin, current ratio, inventory turnover, interest cover, and earnings per share. Net profit margin. Net profit margin is the measurement of the amount of net income earned to the percentage of revenue generated. As we can observe from the graph below, the net profit margin of Zara has been consistent throughout the 5-year periods besides the year 2020 due to the global outbreak of the COVID-19 virus. This signifies that Zara has been stable throughout the 5-year period, and when it has an increase in revenue, there will be an equal increase in percentage of net profit. Therefore, this can translate to the stability of the cost incurred by the company as production increases. The consistency and stability of the cost also implies that the company has the ability to scale larger in terms of revenue and production. Investors of the company can interpret this as a sign that the company still has the potential to grow without being held back by the cost factor. The graph also shows us the net profit margin between Bonia and Zara for the 5-year comparison. From the graph, we can perceive that the Bonia has a more volatile net profit margin when compared to Zara. It also shows that Bonia performed better in terms of net profit margin in the year 2022, and according to analysts, the average net profit margin of the retail clothing industry is around 4 to 13%. Hence, both Bonia and Zara are on the high side when compared to the industry average, and thus imply that both companies are doing better than their fellow competitors. Alright, so the next ratio would be the current ratio. Current ratio is defined as the current assets divided by the current liability. It compares the company's asset to the company's liabilities and is used as a liquidity ratio that assesses the company's ability to repay short-term debts. Investors use this ratio to judge the company on how they maximize their current assets to fulfill their current liabilities. Based on the data presented, Zara's current ratio has been increasing since the global pandemic. This shows that the company's recovery is going smoothly and its ability to handle short-term debts is more prominent. However, investors typically prefer low current ratios between 1.2 to 2, as a high current ratio translates to the inefficiency of working capital management of the company. According to the graph of the 5-year comparison between Bonia and Zara, we can make out that while the current ratio of Zara has increased, the same could not be said for Bonia. However, Bonia's current ratio is approaching the optimal and ideal current ratios for investors. Hence, this could be a very good sign for Bonia, as its current ratio does eventually drop and is maintained at a 1.2 to 2 range. Since Bonia's current ratio in the past 2 years is higher than Zara, this points to Bonia having more liquid assets than its current liabilities. Therefore, Bonia has a better ability to settle its current liabilities. For the third ratio, we'll be talking about the inventory turnover ratio. Inventory turnover ratio is the rate at which the goods in inventory are sold and replaced. A high inventory ratio could be understood as the company having a solid sales performance, but could also indicate that the company has an insufficient inventory. Whereas a low inventory ratio means that the company could have a poor sale or holding too many stocks in their inventory. Another useful information that we can obtain from the inventory turnover ratio is the highs and lows of a company in a period of time, where the company can use this information to identify the peak periods of their company and therefore adjust and plan their manufacturing, pricing, and purchasing accordingly for the next year. Users of financial information use the inventory turnover ratio to judge the operational profitability and the net income of the company. Based on the inventory turnover ratio by days for Bonia is substantially higher than of Zara. This could mean that the sales of Bonia are not doing as well as Zara, but considering the fact that Zara is an international company, it would be understandable that Zara outperforms Bonia in terms of sales. However, Bonia's inventory turnover ratio has been decreasing, which is potentially a good sign, which could represent the increase in sale in the year of 2022. From the graph, we can also conclude that Zara's ratio throughout the 5-year period has been fairly idle and did not really change as rapidly as Bonia's. Zara and Bonia could both adapt to some improvisations, such as investing in an inventory management, more accurate on the forecast on demand, enhancement of procuring procedures, and the efficiency of market strategies to improve their inventory turnover ratios. Next, we'll be talking about the interest coverage ratio. The interest coverage ratio is a debt and profitability ratio that is used to work out the company's ability to pay interest on its outstanding debt. A high interest coverage ratio interprets to the amount of risk a company holds onto relative to its current debt for future borrowing. Investors use this ratio to determine how well a firm can pay off the interest due on outstanding debts and to assess the risk of investing in the company. This ratio also educates the investor about the financial health of a company, and the general consensus is the higher the interest coverage ratio, the better it is. A ratio of 1 indicates that the company spends equal amount on interest as it earns, and a ratio of less than 1 indicates that the company spends more on interest than its earnings. This usually means the company is in a tough spot and its financial health is seriously deteriorating. As illustrated, there is a clear difference between the ratio of Bonia and Zara. This signifies that Zara has a better ability and a lower risk in regard to the ability to manage its cost of debts. However, an interest coverage ratio that is too high does not necessarily be a good sign, as it could be the evidence of financial inefficiency. Financially efficient companies use debts to invest in new projects to bring about a higher return on capital. Therefore, companies should never give up on the opportunity to invest potentially high return on capital projects just to boost their interest coverage ratio. And lastly, the EPS ratio. The earnings per share, EPS, of a company is a formula that states the capacity of a firm to generate net profits for the common shareholders. The EPS ratio is a very commonly used ratio by investors to determine the value and profitability of the company in reference to a share price of a company to its true earnings. Investors hold firms with high EPS in high regards, as a high EPS ratio translates to high potential for the increase in existing dividends. The differences between the EPS ratio of the two companies is tremendous, but this could be due to the differences in the number of outstanding shares between both companies, as Bonia may have issued too many shares in relative to its net income. However, this does not imply that it is a bad decision from the company, as they may have wanted to raise their capital by issuing more shares in the beginning. In the year 2020, Bonia completed its share consolidation process, reducing the number of total outstanding shares from a total of 8 billion to 2 billion. This proved to be a good strategical decision because as of the year of 2021 and 2022, Bonia's EPS has increased significantly. If we look at the year 2021 and 2022, Bonia's total number of shares outstanding has not increased, but its net income has increased 3.5-fold, as this is a decently good improvement from Bonia, as its EPS is on the uprise. Next, I'll pass to Ching Jien.
So I'm Ching Jien, and I'm going to present the 2 years ratio for Bonia. So first of all, I will presenting the gross profit margin ratio first. Is one of the important factor of metric analysts and investor to watch, since it could help them to determine whether the company is financially healthy. in year 2021, the gross profit margin of Bonia is 52.43%, and it increased to 57.8% in 2022, which showing that Bonia is financially healthy. And the ROE, which is the return on equity of Bonia, also seems optimism since it's having higher return from equity from the past 2 years, which from 4.43% increased to 13.2%. Next, Bonia also more efficient on generating profit from its asset based on the result of asset turnover ratio from 0.45 times in year 2021 increased to 0.54 times in year 2022. Besides, Bonia also more efficient to pay off its current liabilities by liquid current asset from the perspective of increase of quick ratio, which from 1.9936 increased to 2.0841. For trade receivables collection period, which is determined by the average period that the Bonia can collect back the payments from its customer, in year 2021 is 34 days, and it decreased to 30 days in year 2022, which showing a good result. And for trade payables payment period, is average period for Bonia to pay back its payable payments to its supplier and creditor. It's from 12 days in 2021 increased to 19 days in 2022. It may be a sign that showing Bonia having cash flow problem. Next, for leverage ratio, for leverage ratio is how many percent of assets was financed by liabilities. The table shows that 34% assets were financed by total liabilities for both 2 years. Next, for dividend yield is a financial ratio that measures the annual dividend income an investor can expect to receive from an investment, typically in the form of dividend. The investor expect to receive 10.16% in year 2022, which higher than year 2021 shows that the company earned more and able to distribute the dividend more to the shareholders. Finally, for the P/E ratio, which is the price earning ratio, it compares the current market price per share of a company stock to its earning per share over a specific period. The P/E ratio is a fundamental tool for investor to gauge whether a stock is overvalued, undervalued, or priced reasonably in stock market. From the table, we could see that Bonia price is undervalued since it's lower compared to year 2021. So for the conclusion part, I will pass to Lau Yue Hin.
Thank you, Ching Jien. So, in conclusion, since Bonia and Zara have their own benefits and disadvantages, we couldn't tell whether should Stallion Berhad's finance director to invest Bonia or not. Although Bonia is still a high standard company, but when comparing to Zara, of course, Zara will be a better company among them because Zara is a huge international company. So, in our opinion, as a local company in Malaysia, Bonia can learn most of Zara's advantages to improve their level and standard. So next, I'll pass back to Ching Jien for the recommendation to the Stallion Berhad's finance director.
For the recommendation part, since Bonia demonstrated its adaptability and perseverance, presenting more stable and reliable profitability trend as the table shows from the previous slides, our recommendation to Stallion Berhad's finance director is we suggest that they can go ahead with the investment in Bonia, since Bonia is not a low standard company at all, although they may have lower standard compared with Zara, since Zara is international company. Besides, Bonia has consistently showing a strong financial performance over the last 2 years, which exhibiting strong profitability ratios, good liquidity with high current and quick ratio, and also is resilient to manage its debts. Although Bonia's trade receivable collection period is quite high, but it shows that it has declined rapidly in just only a year, which will benefit investors to invest, as Bonia might have lower trade receivable collection period in the future. We think that Stallion Berhad's finance director should trust or count on Bonia because Bonia has the stability performance and is reliable for the past few years. We also think that there will be no recession economic situation on Bonia in the future. So we think that it's suitable for Stallion Berhad's finance director to invest in Bonia company. And this is our analysis and presentation. Thank you.